My name is Andoni Nicolau, and I am the head of digital assets at Geltec. And this is part 2 of our cryptocurrency webinar series. Today, we're going to cover a number of topics. I'm going to start off with taking a look at the market sell-off, which has occurred over the past 12 months, specifically in cryptocurrencies, and more generally at the macroeconomic environment that we currently find ourselves in. We're then going to look at adoption trends within cryptocurrency and how we see that playing out in the near future, what role stablecoins play in the economy, what the most recent update in terms of regulations is, and then lastly, we're going to look into custody, and I will cover a little bit of what Geltec is currently offering. I do have my colleague Chris in the room as well, so if there's any audio or visual issues, Chris will just let us know and we will attend to those, but we don't see any reason why that should occur. I'm going to just turn my video off for the remainder of the presentation just to ensure that bandwidth remains okay. And if you guys have any questions during this webinar, please do feel free to insert them into the Q&A or the chat. And if time allows, I'll be happy to address those questions at the end of the presentation. So thanks very much for joining, and I hope you find the information in this webinar valuable. So let's jump straight into it. Okay, so we've seen a pretty big market sell-off over the last 12 months, and not only in cryptocurrencies. We're seeing markets drop off around the globe, and I think this owes to a generally uncertain atmosphere in markets at the moment, and the outlook is not looking very good either. And there's a number of reasons that may explain this, but there are some very obvious events that I think are creating the environment that we currently find ourselves in. First and foremost, the pandemic and government's responses to COVID, which was by and large lockdown throughout most regions of the world. And then secondly, the other major event that we're witnessing right now is the Russia-Ukrainian war. And it's kind of like a perfect storm in how each of these events has culminated to find ourselves where we are. First and foremost, with COVID, what were governments doing pre-COVID, and what are the effects of that are filtering through now that we are now seeing? So their responses were twofold. Number one, from a monetary policy point of view, it was extremely loose, where most central banks made facilities available. They created new money. It was a very low interest rate environment or lowering of interest rate environments, and they were trying to use that cheap money to prop up markets and ensure that economy stayed stimulated, all while actually locking down the real economy, preventing people from trading freely, and slowing down the actual flow of those goods and services that we come to regularly expect in normal conditions. So following on from that response, they reversed monetary policy and reopened the economy. Now we're looking at tightening conditions where there is less money printing, and we're seeing rates being increased. The Fed recently rose their rate by 75 basis points, and a few days later, the SARB followed suit and also raised the repo rate by 75 basis points to 6.25%, which is almost at the same rate where rates were in 2016 to 2017. So it really is tightening that. Couple that with the large amounts of debt that we see in the economy. Anytime rates raise, that puts pressure on borrowers, because it means to service their debt becomes far more expensive. They then have to find cash flow to service that debt or draw down on existing investments. Now, throw into the mix the Russia-Ukrainian war, which has caused major disruption in Europe and to global markets, because they are both major producers of commodities and most notably of energy. And that is resulting in a shortage in supply and a breakdown in supply chains. So it really is slowing down normal trade that we are used to seeing, and it's throwing in a large amount of uncertainty into the market. And what investors tend to do when there's uncertainty is they look to avoid risk as much as possible. And we call this a risk-off sentiment. So they divert capital from any risky assets and they try and move them into relatively less risky assets. And what does that mean? That means that they take money out of stocks, and most certainly they take money out of investments like cryptocurrencies, which is still very, very much viewed as a risk-on asset or a highly risky investment. So investors pull capital away from those risky investments and they dump them into so-called safe investments, such as holding it in pure cash. Generally, the rush is towards the USD, and we're seeing that with devaluation in any currency that's not the USD at the moment. And they tend to look to invest in treasury bills or government bonds or longer dated treasury bonds, as those are seen as far less risky than your typical stock, and certainly way less risky than cryptocurrencies. So as a culmination of all these reasons, we're seeing a lot of capital being pulled out of cryptocurrencies, and that's certainly played a part in the massive sell-off and devaluation that we've seen since early November, late October last year. So it's almost been a full 12-month cycle where prices have fallen off of those all-time highs that were seen back then. Now, again, just to put into context and to see that this is not simply a crypto phenomenon, it's a general macroeconomic phenomenon where markets are selling off. This is a snapshot of the Dow Jones since the beginning of the year. So down almost 12% year to date across the entire index. And then if we pull out a couple of well-known name brands and companies like Nike, JP Morgan, Walt Disney, these are very well-established brands, massive companies. And even they have not been able to break away from the general macroeconomic downturn that we are witnessing. And those are rather large devaluations. For a company like Walt Disney or Nike to drop off by 33% year to date is extremely significant. So we are witnessing a contraction and quite a major downturn generally across all investment markets. Now, if we take a look at the NASDAQ, we can see pretty much the same thing. Across the index, down about 22% year to date, which is more significant than the Dow Jones. And again, when we pull out a couple of well-known brands, Apple, Microsoft, Amazon, these are three of the largest companies on earth, and Tesla, you can see there that they're also not immune to the general downturn in markets and the sluggishness that we are seeing. So if we now shift on and take a look at what's happening in the crypto markets, we can see that it is also significantly down, and it's down quite a bit further than the individual stocks that I pulled out on the previous two slides. Now, this to me is not surprising at all. Crypto markets tend to be very cyclical. So if you look at the 4-year cyclic history of Bitcoin and the general market, a lot of the new cryptocurrencies are a lot younger, so you don't have as much of a history to look back on. But if you look back at the price history, it is very cyclical. It does tend to follow a 4-year cycle of boom and bust. So it does make sense that we are selling off from the highs that we reached last year. And to the extent that we've seen a sell-off, where we see Bitcoin down 50% year to date, Ethereum 55% year to date, those numbers are even larger if you take the downturn from the absolute peak, which we saw early November last year. Those numbers look more like 70 to 80%, and in some cases even 90%, depending on the token. Now, again, this is not surprising to me because you would expect a drawdown after all-time highs are reached. And The magnitude of the drawdown is also not atypical when you look at previous cycles and previous sell-offs. And then when we throw into the mix that there is a very bearish macroeconomic environment, that investors are predominantly looking to avoid risk as opposed to allocate to high-yielding assets, it makes sense to me that the magnitude of the sell-off in cryptocurrencies is 2 to 3 times larger than what we are seeing in the stock market. Because when you look at the stock market, it is much more developed. There's no regulatory uncertainty. Brands are well known. Companies are well understood. The products are very well understood. So the information that is available when it comes to evaluating the stock market versus evaluating the crypto market, there's far less uncertainty. And so a volatility magnitude of more of 2 to 3 times would make sense to me, and that's why these numbers are no surprise to me. Now, if we zoom out and look at the market as a whole, as I said, last year, early November was where the market peaked. This chart is just showing from as of the start of this year, so January 1st up until the start of September. So this is a few weeks outdated, and we've dropped off slightly more since then, but nothing too significant. But as of that peak, where the market had a valuation of over $3 trillion, we've now since dropped off, and the market in its totality is valued at just under $1 trillion. Again, nothing too unexpected, still a very significant market. If we compare that to what we see in other markets, the silver market is valued at $1 trillion, so almost as valuable as the silver market. Gold market is valued at just over $12 trillion. And I think, as you'll see in the next section, when we look at adoption, I think ultimately the trend is saying that we will eventually find a bottom, and the market cap of cryptocurrencies will grow and potentially one day even match the market size of gold and overtake it, and potentially go even further than that. So again, very bearish environment, very negative sentiment. But what we would be looking for in the sort of next 6 to 12 months is for the market to really find a bottom, and then start to pull in more and more capital, where we can sort of enter the stages of that next bull cycle, where we start to see some green numbers posted on the board. But again, I think this will largely be determined by the macroeconomic environment, which, as I've explained, is still extremely uncertain and still extremely bearish at the moment. So that's kind of a broad-based snapshot of where the market is at the moment. I now want to take a closer look specifically at cryptocurrencies and what we're actually seeing happen fundamentally and organically. Are people using these cryptocurrencies? Why are they using them? And do we think that trend is going to continue and that demand will keep growing in this market? So first of all, before we go straight into cryptocurrencies, the overall trend that I think we've been seeing since the late 80s, so for the last 30 years, has been a trend towards digital and digitization of everyday activities, and specifically our economic activities. Today, we probably, a good portion of our economic activity is spent online as opposed to in the physical world. And we can see that just by thinking about the companies that we use in our day-to-day lives. How often do we use Amazon to go online and purchase a product, as opposed to getting out the house, going down to the hardware store or to the grocery store, whatever it may be, to purchase your goods? A lot of those purchases are now actually happening online and being delivered directly to one's doorstep. And that's why Amazon is the retail giant that it is today, because more and more people are simply using that platform to make their purchases. Then even when we look at things like entertainment and socializing, the bulk of or more and more of the time in our day is spent on doing those things on online platforms. And especially if you look at the younger generation, they spend even more and more time on websites like Facebook, Instagram, They consume their news mostly from Twitter, new apps like TikTok. So entertainment and socializing has now also predominantly been digitized and moved into the online world. And gaming, of course, the interesting stat for me there is that in South Korea, there are more professional online gamers than there are actual professional sportsmen. And that is, yeah, that to me is quite a scary stat. And it just goes to show what the younger generation is doing. They're spending way less time outside and way more time online, playing their games in these digital worlds. So there's an overarching trend away from, let's call it the physical world or the analog world, and more and more things are moving on to online platforms. And the last piece of that puzzle, which never really fully migrated to digital, was money and finance. So even though we are able to transact online with credit cards and debit cards and send wire transfers, the actual underlying money and the underlying system that dictated how our money operated and what those rules were was never fully digitized. It was still the old institutions. So it was still bankers, other financial institutions, and central banks that actually set the fundamental rules of how money functions in an economy. And only once Bitcoin came around in 2009 did we actually invent the ability to create independent monetary networks that were completely natively digital. And that kind of was the last piece of this digital puzzle, which we are now seeing emerge and we're seeing develop extremely rapidly. And how quickly has that development been, and what are we seeing happen? And there's massive amounts of innovation. The market itself, if we age it by Bitcoin, is only 13 years old, and much younger if we consider a lot of the newer tokens and newer protocols that are emerging. But essentially what's happening is there's an explosion of innovation and an explosion of competition, where once we realized that we could create these independent monetary networks, we are seeing now the proliferation of thousands and thousands of them, and they're all competing against one another. And I think this is good. It's healthy. Markets should be competitive, and the markets will ultimately decide what succeeds and what fails. And this chart goes to show exactly what I'm talking about. So 5 years ago, if we put together a similar chart, you'd probably see only a handful of these protocols actually existing, and only a fraction of the amount of revenue that's being generated by these protocols. Whereas today it's grown to an extremely significant number. So if we look at the second largest cryptocurrency by market cap, Ethereum, the revenue that's generated directly from that blockchain is $2.7 billion as of the latest calculations. And then we have a range of competing and complementary protocols that have emerged that are also starting to capture a lot of investment and a lot of value. So we are seeing sort of from a broad perspective, what we're seeing is more financial transactions take place on blockchains, or starting to take place on blockchains, as opposed to centralized financial institutions. And if that trend continues, we would expect to see these numbers continue to increase. Now, if we look specifically at the Bitcoin blockchain, and we take a very, very basic and easy to find data point, which is the number of addresses that exist on the Bitcoin blockchain, which is somewhat proportional to the number of individual or unique users that are actually using Bitcoin and interacting with Bitcoin, we can see that there's a very clear and obvious trend. That trend is sloping upwards, and is increasing, is going up in time. So again, if we think back to 10 years ago, who was talking about or using or investing in Bitcoin? That was practically nobody, which is reflected in the number of addresses that were visible on chain, to now reaching a number that has just recently passed 100 million addresses. it's clear to see that more and more demand is coming into the system, and more people are finding value and starting to use Bitcoin for whatever their specific reasons are. But there's very clearly that natural demand that is filtering through and attracting users onto these digital networks. Similarly, in Ethereum, if we look at the number of transactions that blockchain has actually settled and processed over its lifetime, if you look to just 6 years ago, it was a very, very small number, in the single-digit millions, if even in the millions, whereas today we are seeing more than 30 million transactions settled per week on the Ethereum blockchain. And that's a 40 times increase from 2016. So again, it's pretty obvious that these networks have value, and because they're valuable to users, it's attracting new demand, and that can be seen in these usage statistics. And if these trends are to continue, we may not be able to extrapolate it directly proportionally and say in another 6 years we'll get a 40x increase, but it's very, very likely that it'll increase by orders of magnitude going into the future as these networks become easier to use and more accessible to the general population. Now, a snapshot of where I think we currently are and where the globe currently sits in terms of adoption. The best estimate right now is that there are 300 million users of crypto worldwide. Interestingly, I think you'll find more of those users in developing nations because they don't have great infrastructure and efficient markets that allow them to easily invest or transact globally. They are finding it easier to now actually use a blockchain or a digital network to store their value and perform their day-to-day transactions. And I think this, again, is significant for two reasons. It shows that there's been rather rapid adoption over the last decade. 300 million is a very significant number, but it also shows that there's enormous room for growth in the near future and in the medium term. Because if we put 300 million into context, although it sounds like a very large number, if we compare that to established networks, something like Amazon.com, where they register over 2 billion unique site visits per month, okay? And with 4.9 billion individuals in the global economy that have access to the internet, and with access to the internet means they can easily access cryptocurrencies and use cryptocurrencies, you can see that 300 million is still less than 1% of that potentially addressable market. So there is enormous room for growth on the demand side for cryptocurrencies. Now, one of the other trends that we are starting to witness is corporate adoption and business adoption. And typically, any new technology goes in those stages, where first they're by individuals on the fringe, where people who like to experiment and test out new things. If it proves useful and reliable, it then spreads to a larger majority of individuals that use it. And if it becomes popular enough and large enough, it then logically spills over into corporations and businesses who then want to appeal to that market that is using this new technology, and thus they adopt it themselves. And what we are seeing. So even a company like Visa, who typically would probably be considered competition to cryptocurrencies, is starting to integrate crypto into their own network. So they are developing debit cards that can be funded with cryptocurrencies and then used at any one of their 70 million outlets around the world. And they are doing it because it's valuable. So these technologies are competitive, but they're also complementary. So I would expect to see the usability and that interoperability continue to improve as the market develops and as more and more companies start to see value in these technologies and in cryptocurrencies specifically. Another interesting trend is with online merchants and online platforms. So late last year, Twitter launched a new tipping function, which essentially allows any user to tip any other user with Bitcoin, transact, and that being transacted over the Lightning network, which is a second layer network on top of the Bitcoin blockchain. And I won't go into detail, into any technical detail as to how that actually works. But what I think is ultimately going to happen is that cryptocurrencies will just become ubiquitous, just like we rely on cell phones and the internet, and airplanes and any other useful technology that we take for granted. Ultimately, cryptocurrencies will become like that, and they will just function away in the background without most users even knowing that they're transacting on a blockchain network. And as the market develops, as these improvements get introduced, it'll simply become second nature for any of us to choose whether we want to use our national currency or if we want to use a cryptocurrency. And those solutions are coming to market very, very quickly. Now, I want to dive into, or I want to look at stablecoins briefly, because they are one of the largest sectors in the crypto market. They account for more than 15% of the total market cap. And this speaks towards why people are actually adopting cryptocurrencies. And it tells us, it gives us a clue whether or not that adoption will continue into the future. And I'll get into the different types of stable coins that exist, but broadly speaking, why would anyone use a Tether coin or a USDC coin, which are the two largest stable coins in the market right now, as opposed to any other traditional transacting network? And it goes back also to where we're seeing adoption, that we're seeing it in the developing market. And it's quite simple. It's because a huge number of people on the globe don't have access to reliable banking networks, which means they're essentially cut off from transacting across borders, and they cut off from accessing a larger market outside of simply their local community. That's one reason that they're cut off. And the second reason is that they have unreliable national currencies. You know, if you, I mean, we're all aware of what Zimbabwe went through in the late 90s, early 2000s, and to an extent are still going through now, suffering through hyperinflation. And it's not just isolated to Zimbabwe. We see this happening way too often around the globe, right? Lebanon's banks have all been closed out, and people have been shut down from accessing their savings and accessing their money. In fact, it's a very interesting case to study. You know, people have actually robbed their banks just to get access to their own accounts. Such is the magnitude of the crisis there. Venezuela is another example that is going through 1,000% annual inflation, and they've been suffering through that for a number of years. So these economies cannot rely on their national currencies as being a stable unit to either transact in or to store their savings in. And so what these people naturally do is they look for alternatives, and with cryptocurrencies, they have an accessible and reliable alternative. Now, for some people, that may mean holding Bitcoin or holding Ethereum, but for a large sector of the market, they turn to stable coins because they trust the dollar, they trust the value of the dollar, and they're now able to access that dollar on a cryptographic network. And it means that they can transact simply by having an internet connection. No one can cut them off. No one can block them from transacting. It's far more efficient and far more accessible. And those are the main reasons why we're seeing such a rapid adoption of these crypto networks. Now, there's two main types of stable coins that exist in the market. First and foremost, we have our asset-backed stable coins, which are the biggest and most reliable. Tether and USDC, I'm sure many of you are familiar with, but there's a wide range of other types of stable coins that do exist in the market, and these are asset-backed stable coins. So for every unit of tether that is created, that tether is supposed to be backed by a physical dollar in a bank account. Now, what this requires is it requires trust in the issuer, in the stablecoin issuer. In this example, the company being Tether. So anyone who uses a Tether token is trusting that that counterparty is responsibly maintaining the peg of that stablecoin. If they mismanage those funds or allocate them somewhere else and end up losing those actual physical dollars, then they risk losing the stablecoin peg, and a Tether could then become devalued and not be worth $1 anymore. But to date, they have remained solvent. During the massive sell-off, when companies in the crypto space like Celsius, like Three Arrows Capital, like BlockFi were going through their liquidity issues and falling into liquidation, there was a general market panic, and Tether actually managed to honor $7 billion of withdrawals within 24 hours. So that was a very important stress test for their systems and for their liquidity. And they passed that test ultimately with flying colors. So asset-backed stablecoins are pretty well trusted by the market. And if there were to be any misgivings or or if anyone suspected any fraud or foul play, I think the market would sniff that out pretty quickly, and it would be reflected in the price relatively quickly. Now, the other type of stable coins that exist are algorithmic stable coins, and these are far riskier and far less reliable and far less well developed. Let's say these are still very much experimental, and this is evidenced by the collapse of Terra Luna, which had a rapid rise in the middle and late half of last year, and then pretty much collapsed to zero within the space of about 2 days, where anyone who was holding that Terra token would have lost essentially 100% of their value that was committed to that. So any algorithmic stablecoin should be approached with caution. These are still extremely experimental, and they work quite differently to asset-backed stablecoins. Their peg, or their one-to-one valuation, is supposed to be maintained by an algorithm that has been developed by a group of developers or whoever contributes to an open source project. And that algorithm is supposed to regulate a basket of assets. So whether it be physical dollars or a mix of dollars and euros or a variety of currencies, or if they add commodities. In the case of Terra, they were supposed to have Bitcoin that would back the peg of the stablecoin. But in any case, a long story short, that system failed and crashed to zero in a very, very short space of time. So far less reliable and far less stress tested. So definitely something to approach with extreme caution at this point in time. But ultimately, the rapid adoption Now, the flip side of this are hindrances to adoption. And right now, we don't have explicit regulations in South Africa that deal with cryptocurrencies, and most other jurisdictions around the world also don't yet have explicit regulations. And this has been one of the major hurdles and hindrances to adoption, and particularly for financial institutions and large corporates and public companies who don't want to be on the wrong side of the regulations, so they tend to simply avoid this market altogether. But where do we stand currently, and where do we see regulations going? By and large, the attitude right now is overwhelmingly positive. Cryptocurrencies have been on the regulators' radar for a number of years now. So it has been relatively slow. I would have expected regulation to have come a lot sooner. But nonetheless, we are where we are, and we're at the point where most of the major regulators have said that we can expect explicit regulations within the next 12 to 18 months. And what those will look like is that cryptocurrencies will be regulated as a financial asset. So it's not going to be classified as a currency or a commodity. And the overarching intention and goal is to bring crypto under the regulatory umbrella of existing laws, with one or two definitions perhaps added to speak specifically to cryptocurrencies, and so that it's part of the mainstream financial world, and where it can be accessed by any investor that is actually looking to get into this asset class. And this is very positive because it will allow a lot of the institutional money to actually now consider it as a serious investment and put an allocation into the asset class, as opposed to just sitting on the sidelines like most have been doing with this asset class. Now, slightly more specifically, who are these regulators, and what have they defined thus far? The main regulators that we are worried about would be the South African Reserve Bank, the Revenue Service, SARS, and FSCA. And again, a lot of this guidance already exists, and it is how we at Geltic already treat cryptocurrencies and any investments in crypto. But these are the major concerns from the different regulators. So from the SARB's point of view, they are mostly concerned with general stability in the economy, and one of the most important points there being capital controls. Many of you may already know that each individual is limited to a certain amount of ZAR that we can send offshore per annum. That number right now is 1 million discretionary and 10 million as part of a what's known as an FIA, foreign investment allowance. And they are particularly concerned that cryptocurrencies are not used as a conduit to escape capital controls. And yeah, again, that's pretty sensible, pretty self-explanatory, because that same rule applies to any other conduit or any other asset that may be used to subvert those capital controls. So that is their main concern right now, and they want to ensure that there are controls around that. Then from a SARS perspective, of course, they are concerned with taxing gains and keeping track of individuals' investments. And right now, they predominantly rely on individuals reporting their own gains. And the other avenue that they can rely on is by accessing records of the major exchanges and major service providers that transact a large amounts of volume in this asset class. And right now, again, the guidance is pretty clear. It's not murky or confusing. Cryptocurrencies are regarded as an intangible asset, and the tax treatment therefore depends on the usage. So gains can either fall into the income category or as part of capital gains tax. And again, there's a variety of factors that will inform that decision. But in general, longer term, lower frequency investments can be considered as capital in nature, whereas higher frequency short-term trades will be generally considered as part of that individual's income and taxed as their income. And then finally, the FSCA, essentially the overseer of the financial sector, consumers, and service providers, or middlemen or brokers or investment houses, ensuring that they are appropriately accredited and responsible in the way that they approach the market and market their investments and attract individuals to invest. And what we expect to see from them is that they will create a new classification known as a CASP, which stands for Crypto Asset Service Provider. So that will cover brokers, exchanges, mining services, anything related with handling cryptocurrencies and selling some type of service. That will be classified as a CASP, and we would expect there to be accompanying accreditation and licensing that comes with that classification. So all very positive, all very welcoming, and this, when this does eventually arrive, this will remove essentially the final hurdle that would prevent either individuals, corporates, or institutions from investing in this space. So that's what it looks like locally in terms of regulations. If we sort of zoom out and see what's happening or compare what we've done to what's happening globally, the picture is pretty similar. There is quite a lot of legislation that's being pushed through in the United States. Europe has typically been pretty unfriendly towards crypto in general, but that is starting to change, and it's starting to be incorporated into the general financial legislation that exists in Europe. And then we have two currently unique cases, those being El Salvador and the Central African Republic. They've been even more positive towards the space, where they've taken the step to actually define Bitcoin as legal tender. So it is legal currency. It's exempt from tax due to its legal tender status. And they've completely legalized the usage of cryptocurrencies in general within their borders. So those will be two interesting nations to monitor and watch and see how they develop, and to see whether their positive treatment or their positive outlook to cryptocurrencies actually grows their economy and develops it better there than potentially than it does over here or abroad, where there are slightly more stringent controls. So those are just two interesting cases that will be interesting to see how they develop. Okay, and then the last rung of the adoption scale, banking and institutional adoption. As I said, the major hurdle for these finance houses has been the uncertainty around regulations and legality. But now, as those regulations become more clear, and there is less and less uncertainty, and it spreads to more and more regions around the world, that uncertainty then disappears, and that allows many of these major institutions to incorporate cryptocurrencies into their day-to-day dealings, and it allows them to actually offer services, as many of these names that you see on the slide right now are already doing. Morgan Stanley, JP Morgan, Goldman Sachs, those are three of the biggest banks in the world. Barclays, Standard Chartered, these banks are already offering some type of crypto services. It may not be to the entire consumer base. In some cases, only to high net worth or accredited investors. But you can see that accessibility and the avenues for investors and consumers to actually access these investments are increasing and becoming easier and easier to find. And again, because this market has value, these banks are compelled to offer it, because then they will simply lose market share and lose those clients to another institution that would offer these services. And so I would also expect to see South African banks following suit. Our local banks have actually had a very negative view towards cryptocurrencies, which once those regulations come through, I would hope to see that easing, and potentially you'll even see those services integrated into the banking services, where you may even have the ability to invest directly in cryptocurrencies straight through your banking app. But we are not there yet, and time will tell whether that actually materializes or not. Okay, now moving on to custody. And again, all of these developments and the opportunity in the space are fantastic, but it means nothing if you cannot actually securely store and protect those assets that you are investing in. And again, I think this has been one of the major hindrances to adoption, in that investors have been they've been cautious to get involved because of the hundreds of horror stories that they've heard about in the cryptocurrency space. Now, when coming into the space, one should do a little bit of research to understand where is it safe to hold these assets, and how should they do it. And there are a number of various ways that they can do that. Typically, we see a lot of unsophisticated investors leaving their assets on exchange, which is extremely risky, because it's being left with a third party that historically has been very vulnerable, and even today is still very vulnerable to external hacks. And I'll show a brief history of what we've seen in terms of security breaches on exchanges. Then we also have solutions that are broadly referred to as hardware wallets or paper wallets. which tend to be a DIY solution. And again, for technically astute investors, those are pretty good solutions. But we've also seen a large amount of loss occur with cryptocurrencies simply due to user error. Things like forgetting a password, not creating an accurate backup, not having a plan to pass on those assets if something were to happen to the individual who originally bought them. So succession planning, a number of those mistakes or errors have resulted in irrevocable loss. So that is also a threat that needs to be understood. And then lastly, we have seen, especially over the last 2 to 3 years, we've seen the emergence of third-party custodians and regulated third-party custodians, which is essentially exactly like you trusting your bank to hold your R1 million savings. A third-party custodian would do the exact same thing, but for your cryptocurrencies. Now, there are a lot of threats that are prevalent in the space. And again, depending on how technically astute you are, you may or may not be able to recognize those threats. Things like phishing attacks, which we are seeing proliferate at an alarming rate. Malware that could potentially infect your computer or your devices. And that malware could steal any value that's kept on your phone or any information that is kept on your hard drives. Remote hacks, and even physical hacks. When people, there have been cases around the world of people actually advertising the fact that they hold a large amount of cryptocurrency, and they've fallen victim to physical attacks where people have actually forced them to hand over their keys and hand over their cryptocurrencies. So all of these threats are very real, and it should be taken into consideration when deciding whether to invest in this asset class, and once you've invested in it, how are you actually going to protect those assets and where are you going to store them? And so when I consider these risks, what I like to do is I like to put the options on a spectrum. You typically, when it comes to storing something, you have a security and convenience spectrum, where if you have maximum convenience, it's easy to access, but it's not very safe, versus having maximum security, making it very hard to access. But you have the peace of mind in knowing that those assets probably cannot be accessed by anyone else. So I like to put the different options on a spectrum, and this is just my evaluation of where each of the options land. Other people, depending on how they assess the threats to their assets, might arrange this differently, but it's simply a good framework to put together to decide where you actually want to store those assets and how you want to keep them safe. Now, looking at why exchanges are such high risk and why it is not advisable to leave your assets on a crypto exchange, is simply because of the massive amounts of loss that they have incurred, and the amounts of attack that they are consistently under from hackers and external threats. And again, we tend to reduce the risk that we associate with this because it falls out of the news cycle, or we forget when the last major hack actually occurred. But as you can see, if we simply go back only to 2018 up to today, there have been a plethora of vulnerabilities and losses that have been suffered by many major exchanges around the world. A notable one to pick out here is 7th of May 2019, Binance was hacked for $40 million. And Binance is the largest exchange on earth, and by quite a margin. They're significantly larger than the next. And you would assume that by virtue of them being the largest, they would probably have the best security protocols and the most sophisticated systems ensuring that those assets are safe, which they surely do and surely are undergoing upgrades. But you can see that even they are still vulnerable. More recently, in January of this year, crypto.com was exposed for $34 million. They are also a very visible and high-profile exchange, and they were also found to be vulnerable. And the reason being is because hackers will always target exchanges because they know there is a large honeypot and a large amount of value that these companies are are custodying and handling on a day-to-day basis. So if they succeed, then they stand to earn a windfall in value if they can crack those security controls. And this will be true forever. They will always be under attack and always be vulnerable. Thus, it is never advisable to leave valuable assets on a public exchange. Okay, and then lastly, this is similar to the convenience security spectrum. You can list the different options for storing your cryptocurrencies. So whether it be a hardware wallet, leaving it on an exchange for convenience, a paper wallet, or a third-party custodian. And then you can assess the different characteristics of each of those potential storage solutions and then decide which one suits you best. Again, some people might be looking for maximum convenience because they may want to sell those assets as quickly as possible. In that case, they may think that the risk that they're exposed to by leaving it on exchange is worth the extra convenience, and that is their choice. But for those who are looking for something more secure, there are certainly superior options out there, and of course, third-party custodian, from our perspective and from what we are offering, is what we would suggest as the safest solution. So lastly, just to finish off, I want to spend a little bit of time taking everybody through what we are doing at Geltic and what we are offering. And in fact, I'm just going to skip the slide because we were on the subject of custody. I want to go through our custody solution, which we are calling the safety deposit box. So Geltic's cryptocurrency safety deposit box. It's stored completely off exchange, so it is not vulnerable to any external entity or external third party. It is a very sophisticated solution. There are safeguards in place to prevent any external threats. There's safeguards in place to prevent physical theft or physical attacks. And without going into too much detail to kind of give away how we actually do it, all of these protocols have been massively stress tested, and it is a very, very secure solution for any long-term investors that are looking to really lock up these assets for a long period of time, and also to do it in a compliant manner. All of our products are treated as financial products in the crypto, with all of our crypto services. So we are voluntarily compliant already, and any new regulations and laws that come into the space, we will obviously go and get the requisite accreditation and licensing that is required, so that our products, our crypto products specifically, will always be 100% compliant with local regulations. Okay, and now, sorry, just jumping back to the previous slide, we've been offering investment bundles also just over a year now. We launched our first cryptocurrency basket in September of 2021, which is a diversified basket of some of the largest cap cryptocurrencies that exist in the market. That is a basket that also will evolve over time and generally track the largest cryptocurrencies. That basket is rebalanced on a quarterly basis. And then we recently launched a blockchain basket, which is slightly riskier, and allows a little bit more discretion to the investment committee, where they seek to pick out some of the blockchains and tokens that they believe has the best long-term value or the best opportunity to see significant growth, and that is the blockchain basket that we offer. And we also offer direct investments purely into Bitcoin or Ethereum or individual tokens, if that is more the flavor of what investors are looking for. So those are available, and please, if you require any additional information on either of these products or any general questions, please do feel free to get in touch with either myself or Geltic. Our website is there, www.geltic.co.za. You can see all the products that we offer on our website. And then if you have any direct questions for myself, please do feel free to contact me via email. And that is the conclusion of today's webinar. I do hope that you found it useful.